The broadcast is now starting. All attendees are in listen-only mode.
Evening, guys. Microphone check. Testing 1 2. Microphone check. Okay. Awesome. Thanks for hanging in there, guys. So this is FAQ, I think maybe number 7 for February 25th, 2018. I cleaned up the video link page a little bit. Just to refresh everybody's memory. So we've got 11 weeks worth of video lessons and 2 sets of FAQs to each lesson, right? So each weekly lesson has 3 parts then. There's the set of all the little mini lessons from 2016. Those are the conceptual videos. And that's all of these down here, grouped by lesson. And then there is the weekly recorded FAQ session from 2016, and that's these right here, the 2016 weekly webinar transcripts. And so a lot of those tended to be FAQ type questions that had come out of the review of the weekly lessons from the students. And some of those cases were results of strategies or techniques that we had been learning during the week in the chat room, where there were some like emerging strategies and whatnot. So those all are tend to be like lectures and kind of structured the way we're doing these right here. So we have the many lessons from 2016, those weekly recorded sessions down here. And then there are these sessions that we're doing now, recording as we go and then posting those links here. Okay, so this one would be for the February 25th and so forth. There were a number of guys that expressed an interest in doing the course also, and we were already halfway through this one. So what I told them I would do is go ahead and start another series so that they could collaborate together. I see you guys collaborating pretty well, and that seems to be pretty helpful. And so what I've done is I put all of our lessons for this session, or the Q&A, in this one where it says for the January 2018 group, and then I'm going to start them on the March 2018 group. So as I build those, you guys are more than welcome to look at those and listen in on them as well if you're interested. But we're going to keep this. We'll keep this one going for all of your questions, and that way those guys can work and collaborate together. But I am certainly happy to have you guys chime in there, or follow along if you will, and that's fine. The daily podcast, and it's not quite daily, and live portfolio management videos will continue to get posted in this section. And yeah, so that's that. I asked the guys doing the March, starting the first week of March, to put their introductions in here so you can see who's going to be working on that one. I think there's 3 or 4 guys signed up for that. I thought it'd be better for them to have their own start rather than trying to catch up to where you guys are. So let's get back to the lessons. I should say I posted the weekend report review already at YouTube. So I presume you're subscribed to that, so you should have the link. That was about a 20-minute discussion. It included a quick look at Glenn's um, trade results. I'll talk about that in one of the questions for today's lesson. Somebody asked me about that one. And Glenn's doing exactly what I strongly suggest you guys do, and that is he's paper trading forward, using strategies and systems that make sense to him and that are tuned to his timeline and time availability and his understanding. And he's posting those trade frames in the swing trade chat room, and I'm giving feedback on those. And you can certainly give feedback on those too in that chat room. That's the purpose of that one, is to do some live collaborative learning with each other in that room. And then when you transition from the course to just swing trading, you will be very familiar with that as a workspace. And um, that's really the intention of the learning community, is to give you an ongoing area where you can work together. And then I like to think of it as a sort of like a Middle Ages art studio, maybe in Italy, in Renaissance or something, where you can have guys working on their projects in on one side of the workshop, and then periodically pull people over to the other wall and do a quick technique training or lesson training right there inside the workshop, and then go right back to your workspace and work and collaborate with the guys on your left and right. That's really the essence of manufacturing R in an artistic and yet systematic kind of way. So I really encourage you to do what Glenn has done. And then I'm hoping, Glenn, I see you on there. When you're able, if you can send me the those individual trades, the 58 trades, what I'll do is I'll put that into the trade index analyzer, and I will show you how we can use that XLQ and that spreadsheet to give us an analytical tool to explore the specific territory in and around the trades that we're making. The trade index analyzer is a systematic way of seeing how much of the available moves did we get, and were there other pockets of unexplored gold just kind of laying around that maybe we can study and use that to check on our rules. So the first order of business and analysis when you're trading a rule set is to say, am I specifically following the specific rules? And then the second one is to say, now, given a population of trades in that system, how well does that system capture the available moves that were in that general area? And then that way we're checking that's really a second level of checking. The first one checks the fit between you and the rule set. Can you execute? And the second one checks the goodness of fit of the rules to the environment. Or if you think of it as a fishing net and we dip it in there, are we catching the fish, or are the holes too large and a lot of fish getting away, or things like that? So how well are we capturing what is reasonably available? And it's through using that technique, by the way, over the last 20 years or so, that I've been able to investigate different ideas like stop and reverse, the failure patterns like in 5DD and washout pattern, and are those good ideas? Okay, thanks. I'll try to get to that tonight, but I will certainly get to it this week and do some analysis and make that video available, and then I'll show you how we do that, and then I'll open that up to everybody else. All you got to do is do what Glenn's doing, and that is keep a simple trade log of what you're doing. And then this gives us a way to systematically assess. Right? So it's through that technique, looking at a batch of trades, where I've been able to investigate whether or not failure patterns were or continuation patterns. And that's really where both of those on modules, if you will, come from. The continuation pattern was a way to say, regardless of the particular mechanical system that I used to get in, once it had completed a good trade, and then instead of failing back to where it started from, but it continued on and made a new high, and sort of made me regret that I got out in the first place. I said, how could I investigate that as a reasonable reentry? How do I handle reentry and avoid the regret that makes me want to stay longer on the first side? Because if you don't have a way to get back in, then you are tempted by the lure of easy profits, because you remember when it worked. You're lured to say, well, let me not exit when I'm supposed to exit. And it creates challenges for your discipline. And so we need a way to reconcile that. And the first way to do it is to investigate whether or not there's actually opportunities there that we're not seeing. And so the trade index analyzer is going to be a way to do that. And I'll add that to the videos for this week. Glenn has sent me that. So for you, I would strongly recommend that you do what Glenn's doing, and that is trade forward, paper trading until you're ready to prototype, and then document. And all you got to do is document the symbol, the start date, the entry price, the end date, the exit price, and the system that you used to trigger the trade. And then just based on that information, we can analyze them and then group them by category, and you'll be able to see which systems appeal to you on the basis of analysis. Okay. So let's scroll on down to lesson number 7. Okay, so the question was, do I also frame the squeeze setups on the short side, and if so, in what circumstances? And the answer is yes. I frame them in both directions, and the direction that it takes turns out to be the direction that SPY is taking that day, generally speaking. That because my targets are the ETF 30 and the Dow 30, they tend to be strongly correlated to SPY. And so therefore, whatever direction SPY is taking that day, it typically will go in that direction. Now, when it doesn't go in that direction, that's really actually an important piece of information. And so let me diagram that one, if I may. Yeah, so let's say we have the market, and I'm going to put the sector and then the company right here. And let's say that we have the market is up and the sector was up. It wouldn't surprise me when the company is also up. And so if this company is in a squeeze, the reason for that is something like this, that it may have been it could have been a 4 or 5D down. It doesn't have to be, but it could have been, we had lots of moves like this that have large ranges, and then for whatever reason, yesterday was a very tight little doji. And we say, oh, well, that's really unusual. Here we have an inside day. This would be a perfect example of a squeeze candidate, and that is from these large movements, we get an average range of some number, and then the actual range from yesterday is very small. And so when you have that kind of condition, we say the maximum reasonable intraday move is a range stat. I'm going to abbreviate as an R stat. Okay, a range stat. The definition is maximum reasonable intraday move. So that's the max reasonable intraday intraday move. So if it makes that range stat move, we're not allowed to be surprised. But if it goes beyond a range stat, well, then we're allowed to be surprised. So now let's take a look at this little guy here. It had lots of large range days prior, so that means the average range and the standard deviation is probably large. And yet today's range was very small. So in the perfect world, what we have is this kind of range compression that has occurred. And what we'd like to see is a very orderly move. So let's say on the day we framed it, we were willing to buy 5 cents above and go long, and ready to go short if it goes 5 cents below. Now I'm ready to trade that in either direction. And let's say that it opened in a perfect world, it opened exactly where it closed, and so there was no gap. And so the daily move, the maximum reasonable daily move would be the open plus a range stat this way, and from the open, a range stat that way. And that's, by the way, always the case. You know, at the start of the day, that range from, this is a plus range stat, I'm going to call that a plus R, and then a minus range stat, minus R. From the moment of the opening, this whole mental framework says that is the maximum reasonable move that I'm allowed to expect during the day. I think of that as the professional space. So now if my entry is here, you know, it takes off and now it goes up. Now I'm in. And if I'm using yesterday's low as my risk, my risk looks like this. Now, as soon as this thing moves a distance towards a range step, let's call it, even if you just made this a trailing stop, if you get any kind of move out of here, that you're going to be able to get to no lose plus dinner for two pretty quickly. Now, the argument in favor of a strong initial move is this, that you have this very tight doji, and now you have people that believe it's going to go and people that believe it's going to go. So the people who think it's going to go long might have an entry somewhere up in here, and then they're going to put a stop down in here, much like you did. Only they have a logical reason why they want to believe in this trade. And then the people who are going the other way have a logical reason why it should fail. And so they put all their stops up in here. So once this thing gets out of the yellow zone and trips through yesterday's high, it gets into a new region where it couldn't get the previous day. And now the teeter-totter is tilted towards the upside. And all of these little stop losses get hit. And so we end up getting in when those are getting hit. That's these guys covering. And they're all sad. And so the only people left are the people who are buying it and are now in. And so you end up getting quite often a rush of buying pressure as they start chasing. And the further it goes, the stronger that momentum until this little pool of potential buyers is now exhausted. Well, it will take some amount of time for that pool of buyers to be exhausted. And in that time, because we don't believe in this trade, we just look to get our risk out of it. And we raise our stop and get to no lose plus dinner for two. Now, as this thing is rolling up, we know where the range stat move is. And then that's probably going to be somewhere around 2R. But even if it's not, we're going to use the 2R battle drill so that once this thing starts rolling over, we can say, look, we entered here, we risked this much, and now I have this much in hand. And you can simply say, how much of that do I want to give back? And as much as you can give back is going to be no lose plus dinner for two. So somewhere in this space, you get to decide how much money you want to keep. Lather, rinse, repeat. Now, what makes this thing work as a squeeze is the fact that you have an exceptionally tight range that it compressed to on yesterday compared to the large ranges that it had previously. And all you're betting on is that this thing is going to resume a natural or an average range in a particular direction. And then once the direction is voted on early, you're in, and then the natural momentum will take it that way. And then you can get your risk out of there, and now you have some markets money to play with. This has nothing to say, and I've said nothing so far about trade location at all, about any of this whole area, what the shape of any of that looks like. All this needs to be is just relative, it's just noise, but it's relatively large ranges in this cloud that ended up in a very tight doji. So at its simplest form, just some amount of average ranges has compressed into a very tight range, and now the possibility of an average, just an average move, and let's call it, if it got an average move, it would be a change in psychology from the doji. It would actually be a return to normal, and that's why you can get some exaggerated moves out to a range stat. What's the anomaly about this one is the fact that it ended in a doji. And because I'm saying nothing about what that previous price pattern looks like, objectively, I don't have any reason to favor one direction or the other. All I'm betting on is that it's like a straddle position where an excursion away from a breakout from this range now implies an average or better move in that direction. And I'm trying to capitalize on that first move. So I have no directional bias. Now we can do better than that if we want to. Is that the only way? No, we can actually start pairing this with some of these other ideas. For example, if you saw something that was okay, so this is just a squeeze, right? What if you saw this thing paired with a max Payne range compression? This is a very special form of price action that was prior to the range compression in the doji. This is the reason why, and there's an answer. Somebody asked me to explain this a little later, so I'm going to just get it now. The max Payne range compression is my single favorite pattern, like when I'm going from a cold start. Maybe I haven't traded for a couple of days or whatever it may be, and I just want to get back on. And the reason that I sort the daily ETF 30 and the Dow 30 by max Payne range compression is because I like this idea so much, and it gives me short-term, high payoff, low risk ideas. So the idea behind the max Payne range compression now is this idea that there was some moment back here where it reached a 10-day high. So we'll call that a 10-day high. And then it had some sell-off of some distance down to a daily bar that looks like this. Okay. Now, the nature of this sell-off. Well, it had to happen in at least the last 10 days. And so this could have been one big sell-off day, and then it ended perfectly in a doji. That would be amazing. Or it could have been a steady sell-off of 10. It could have been a 10-day down, and it ended in a doji. Or it could have been a sell-off and then a big sell-off, and then a couple days where it just dojied around, and it's almost adopting a sideways quiet channel kind of approach. But the fact is that the 10-day high is still within recent memory, right? Each one of those has a 10-day high. It looks like this. Well, in every case, there's some guy who bought just before this thing collapsed. And that guy is suffering this maximum amount of pain all the way down to this price. And on a percentage basis, so that I can just normalize this, because I want to compare this in the Dow 30, what I want to know in the Dow 30 and in the ETF 30, which symbol is experiencing the most amount of pain. Because I associate greed and fear. You know, fear is a fear of pain. Well, the actual pain, that guy got to recognize all his fear, and he's suffering. He's suffering pain right now, and maybe that's as far as the pain took it. And in fact, the second part of this equation. So max pain is a percentage basis. How far has it fallen on a percentage basis from the 10-day high, wherever that was, no matter this is condition A, B, or C? The amount of pain that he has is the amount of the sell-off. And now the second part of the equation is the range compression. So the smaller the amount of yesterday's range, smaller is better. Because what that means now is we have two different psychological conditions at play. One was this fear that then led to pain and suffering and a decision to sell. And now that guy had sold, and now he's in great pain. Or the guy that hadn't sold yet is in some condition of maximum pain. But these sell-offs tend to be large range and rapid moves. Think of the 2 weeks ago, that sell-off from the previous 10-day high. It was a 4 sigma sell-off. That was horrible. But there came a day when the range actually compressed, and what that means was there was a failure to fail further. Where did all the fear go? Well, the fact that it ended in a doji, which is a small range and a relative balance between the buying and selling pressure, all of that buying and selling happened inside here. And that is a completely different psychological state than is characterized by all this fear and pain and suffering. So this is runaway fear. That's a psychological state. This even battle between bulls and bears across a very narrow front is the opposite of fear. It's also the opposite of greed. Greed is what maybe ran that thing up all the way, and there was nobody on the other side of the trade in a counterbalance, and so that was unadulterated greed. So now we've seen 3 different forms of psychological state: greed, fear, and now we have this indifference or uncertainty. So to get a good maximum, we're going to use a little formula now to describe the condition of each one of these symbols: maximum pain divided by range compression. So to get the best ratio, what you want is the most amount of pain, the biggest percentage sell-off, divided by the smallest daily range. And so in order to get a very high ratio, that's what you want. You want maximum pain divided by range compression. So in a perfect world, we have this enormous sell-off that ends in a little doji. And now we can frame that trade, and we can say one of 2 things is going to happen. It's probably not going to stay in that little doji. And now we can take a look at what was the reason for all that stuff. Whatever the reason is, I don't even know, nor do I care. It could be a combination of reasons. All I know is that people have their own good reasons to sell, and I trust them. Now, the reasons for that are either correct, meaning that there's going to be another leg down, where other people wake up to the fact that this thing was horrible, and they say, oh, there's more pain coming. So the next move is either something of that same magnitude down, or people are going to say, oh, no, that was an overreaction, and this thing really ought to be up where that 10-day high was, or maybe someplace up this step ladder, at least a 50% retracement. And because it ended up in a doji, what we have is an equal belief between the buyers and sellers. And now, in the same reason as the squeeze works, if this thing leaves that doji region and starts traveling up, for the first little bit of this, the more it goes, the more momentum to the upside that it will attract as people who needed some convincing, second and third and fourth and fifth mounts. As this thing starts climbing this ladder, you're going to start getting some buying pressure, and off it goes until all that tactical buying pressure stops and it starts to fade. And now you're in the 2R battle drill. So the max pain range compression ratio tells you what the reward to risk ratio is, just on a simple test of the 10-day high. And because the last psychological domination we saw was a sell-off, if it fails to the downside now, then I just take the size of that move and I say, well, there's a second leg down of equal magnitude until proven otherwise. So if the max Payne range compression ratio back to the upside is better than 2-to-1, then it's also 2-to-1 to the downside. I take that as a symmetrical play. So in this sense, the squeeze play simply needs lots of big ranges. Absolute value of range was large, and it ended in a doji. And then the MPRC is a special form of that because it had all of this large range selling in one direction and then ended in a doji. So the MPRC is a special case. Now, you could also see a squeeze play occur after a beautiful run up, like a parabolic move that ended in a doji. This is another one of those that I'm willing to frame in both directions because maybe this is just the pause that refreshes. And now people are going to say, well, maybe there's a pullback and then a turnaround and go. Maybe people are waiting to see some amount of pullback and then stabilization before they take off. Or maybe they just want to say, hey, let me get on board. If it continues, let me get on board. And then I always take the size of this move and add it to that move. But I can also take this move and go this way. Now, the reason that I prefer the max Payne range compression rather than, we might call this one max gain range compression, is that the emotional power of fear and pain is 3 times greater than the joy of the gain. Right? But in both of these cases, it's what makes it the trigger point is the fact that what used to trade at a very high range has now compressed into this little doji, and that's the anomaly that we're betting on. The max Payne range compression, because it's an after the fear reaction, and in my view, this is 3 times more likely to be out of control or irrational, and that somebody's going to look at this doji and say, aha, failure to fail further, this thing's going to come back to something like a fair value, which may be halfway up. And if this sell-off was large enough, then this rebound, even if it's 50%, is fine. Now, what makes this nice is you get a nice chain trade. Let's say you have a 10-day high, a sell-off into a doji. It only comes up halfway into a doji, and then from that hesitation, it starts selling off again. Oh, I absolutely love that one, because now what you have when we put our Bollinger Band framework on this, we will see this as a high and a lower high, and now we'll have this now becomes a pocket trade, and then my collapsing dragon trade will be right here. So when this thing fails, when this thing starts failing, the collapsing dragon entry is right here. That's the CD. That's the not later than entry. And really what I want is this pocket entry, and maybe this is just a 1, 2, 3. So for me, the max Payne range compression trade allows me to get this first leg up, or if it fails, it lets me get the second leg down, and then sets up all of these little pocket trades, these little failures. Now, if we looked at this on an intraday basis, we would recognize this as an owl trade. And this sell-off would simply be a successful hybrid frog. And then this becomes this little doji down here is probably where you see the P1. And then shortly thereafter, you get an owl entry, or you get a P1 failure. But if the owl entry works, you start getting these pocket trades on the upside. So what I'm describing with the MPRC in this case is nothing more than a fractal pattern about chain trading that we also see intraday. So the reason I like the MPRC is that it is a very relaxed approach to classifying the opportunity on the basis of ranges, the average range versus the current range. So Glenn has, or no, I'm sorry, Alex has asked, is the MPRC useful? Oh, let me put this in here so you can read what I'm reading. Sorry, Alex, let me get back in here. So, is the MPRC useful for EOD trading given we can't see the initial breakout direction until the next day? In this circumstance, would you set up a one cancels the other trade, therefore independent of the breakout rate? Absolutely, yes. This what makes this very powerful for end of day trading is that um, a day that ends in a doji, by definition, is a day in which you can see that the psychology in the market changed. All right, and that is the market is only open for 8 hours ish, and so in this time frame, excuse me, for my time it's open for like 8 hours, and then there's 16 hours until the next opening, and so they were this all of this trading that occurred from the open to the close ended up producing just this little stinking doji. And people were willing to hold that price level 16 hours until it opened again. So chances are, whatever caused this, a big sell-off and then it ended in a doji, all of the emotions from this big sell-off, in my opinion, we have some evidence from the doji that this emotional energy is gone. That psychology of runaway fear is gone, and now it has become this perfectly balanced little teeter-totter here between the buyers and the sellers, and they are duking it out over this closing price in a little doji. So now when it ends in a doji, what I would love to see is hopefully in the overnight session there was nothing that made it trade out of this boundary and create a gap opening. In a perfect world, this thing opens, the overnight trade was just in here, and it opens inside this doji range, and then here's the open, and now it opens here, so it's inside yesterday's range, perfect, and now it takes off, and off it goes, and now it achieves a price level up in here that it couldn't even get to on the previous day, and that now says we now have a piece of evidence which says that the buyers, there's more buyers coming in, and when the buyers come in, they tip the calendar this way, and the price goes up. You get many more buyers coming in. You get on this end, boom, price goes up. It's supply and demand. So that that's a nice condition to be in at the start of the day. And now what we can do is, since we are not just end-of-day traders, although we could be, we now have some reason to believe that a 10-day high is within range in the swing trade time frame. That's if we're swing traders. And so this might be a way for us to get some initial gains. And the reason I like to trade, I call this day one technique, is that if I can put turbo technique on here, I might be able to have 1,000 shares, and then somewhere up in here offload 800, and I can use the gains on the turbo to pay for the overnight risk with 200 shares going north, and hopefully it'll get up to a 10-day high. So this max Payne range compression and these squeeze plays now becomes a way to swing trade one day at a time, and each one of these now represents a single daily frame, and maybe I get a burst and a burst and a burst. And if this thing really is going to go back to the 10-day high, I might actually see 3 or 4 days of directional moves towards the 10-day high, and I've been able to do core and turbo all the way through here and have the overnight risk paid for by the intraday trade. We actually saw something like that in the sell-off in February, when all those, there was this was sort of the average gain implied by the bull, and it did something like this, and then it got sideways, kind of quiet, and then started to collapse. Well, all of this space between the actual price and, say the Bollinger Band mean, all of this stuff was questionable profits. It was like, was that real? Should we have really expected that? And then there were guys who wanted to preserve all of this gain. And so as soon as there was a little momentum of selling, these guys rushed in to sell so that they could lock in all those gains, and that triggered this momentum-based sell-off back to the Bollinger Band mean. Oh, and beyond. So you had one leg and two legs down, and then that ended in a doji. And now we have actually started the resumption of that move to the upside. So in conclusion, then, I would say that the MPRC is very useful for end-of-day trading. It's swing trading one day at a time. It combines the best of both core and turbo. And now, what I want to say is, you can now use the following logic. What I've just shown you is that the squeeze play is based just on the doji compared to a large set of ranges. It reduced into this little doji. And then the MPRC now gives us some insights that if the previous price action was a big sell, the bigger that sell, the more powerful the psychological transition to the doji state is, and that's going to imply a bigger move up or a bigger move down. Well, now you can start substituting some of these other ideas, like a 5-day down, or a triple screen, or the 551W. The Z3P sort of takes this into account, is a more refined way of doing this on a statistical basis. But certainly, channeling and overreaction, all of these mechanical signals now, we can say, like 5-day down, if it was 5 identical days down, we don't have any special qualities of the squeeze or range compression involved there. But if this was a big day down and then 3 more days down and then the 5th day down turned out to be a doji, well, if I had 2 5DD patterns that look like this, then I would prefer the second one because it has the elements of the squeeze play already embedded, and the size of my initial R is going to be smaller than the relative size of this R. What I will tell you is if you don't see any range compression, there's actually a probability that if this thing fails, it's going to be a bigger move than if this thing fails, because we don't even have any buying pressure on this one yet. This thing is just selling off. On the other hand, the fact if you've got a big move down and it ends in a doji, that's because the buyers think this is a time to get long. But if you can actually get a big move if a ton of sellers come in and keep pounding this and the market is melting around it, you could actually get a very large move out of this move as well. And you saw that in the February sell-off also. So to address Alex's question, yes, MPRC is extremely useful for EOD, and that's exactly why I rank order the swing summaries using MPRC ratio. So when we go up here to the Dow 30 Tactical, Walmart is #1 on the MPRC. Now it has a high auto framer number as well. The auto framer uses a slight variation of the MPRC, and that's why not everything that's on the MPRC also has a great auto framer number. But what I want to just show you real quickly is the Walmart #1 MPRC, why this is my favorite pattern. So this is Walmart on a daily, and let's take a closer look at this rascal. This is the 10-day high around 104.69, and it had 1, 2 days of heavy sell-off, and then a day where it failed to sell any further. And that was a day where, when it started to go back up, it simply cashed this. This was a stop and reverse. So Walmart, the original trade, was a 1, 2, 3 entry, and the second position with a stop here, and we got smashed on the big gap down. So you got me. Well done. But then this was stop and reverse. We got some of that money back. That's what happens with swing trading in gaps. Now, the nice thing is that the intraday turbos are not exposed to this large overnight gap, which is triggered by an earnings estimate or earnings announcement. So you can reduce some of your exposure when you're in earnings season. But nevertheless, what you have is this 10-day high and failure to fail further, and now it ends in a smaller range and a really tight doji on Friday. And so somebody was willing to hold this thing overnight 2 times, and then over the weekend 2 times. So I'm willing to simply trade this one 5 cents above, 5 cents below. I'm ready to go in either direction. And then my targets are going to be to close the gap, the RL 270, the Bollinger Band 30. I'm even willing to take, halfway up the price stack here. That would be about a 1-hour move. And then if this thing fails out of the doji, well, then I think this move from the closure down to here, then there's a big move to the downside. If I wanted to get more technical, I could come back over here and say, look, this entire project started from a gap up here, and it's already through that gap. So I would say this cluster of prices over here is a reasonable downside target. This place where it first broke out from the previous sideways quiet is a second price level. So now, as you can see, Walmart is ideally positioned to make a large move in either direction, and there's people that strongly believe that Walmart ought to be up in here or ought to be down there. So there's a lot of room for Walmart to move on a swing trade basis, and because it closed in such a tight doji, then I know there's a real equilibrium between buyers and sellers here, and whoever is going to start that project and gain some of that momentum has a real good chance to improve their performance. So if we looked at this on an hourly basis, look, there was no urgent sell, because this closed Friday. This is hourly charts. Look at that tight range. There was nobody that needs to sell this anymore, but there was nobody willing to buy it going into a weekend. So they're waiting to see what the new week brings. And I'll tell you, if it breaks above this price here, which was above the high, then this thing is going to take off and go. But if it breaks down below the PSAR, well, then off it goes to the upside. So Walmart is going to be a beautiful study in buying and selling pressure. And so we've been able to identify that as to me, the most interesting story in the Dow 30, simply on the basis of max Payne range compression. And if we look back further, you can look at all the pain from the guy that bought this at 104 and is now holding it at 92. He's down 12% in 3 days. Did that guy sell off in here? Well, if he didn't, he's not going to sell it till it gets all the way back up here and he makes his money back. So this is the place where I'd expect that guy to sell now that he's able to get all his money back, because that's typical herd behavior. So there's a lot of people that are going to see Walmart as, if I'm a hedge fund manager or a pension fund, I have to own Walmart as a long-term stable company in my portfolio. So there's going to be a lot of guys that are willing to buy Walmart on a 12% sale. Why would that be irrational? And then, are they going to buy it all at once? No, they're going to start buying it, and then if it starts working, they're going to add to the position, and then they're going to build some gains in, but not Don't wait too long until it gets back to fair value. Based on our strategy for estimating fair value on an hourly chart, looking back 270 hours, that fair value is around 99.80. That's easy to justify a fair value there. If I look back at the daily charts, the fair value is up around 100 and 101. So somewhere between 99 and 100, we should be in agreement that that's a long-term fair value. If I look at the weekly chart, we're still well above fair value. So Walmart has actually been one of the has been one of the price leaders in this long bullish market, this return to making America great. It's been one of the great success stories, and so people will see this as an anomaly. So if we get any kind of recovery, people are going to say, "Holy smokes, this thing was trading up around 100, and we can buy it on sale for 93." Walmart on sale. So as long as Walmart is above this dotted line on a weekly basis, then it's still bullish. And this is just an opportunity to buy a great company on sale. And it's all the way simply back to where it was before this exaggerated um, powerful gain occurred from this Buy American kick. So it's just back to the Bollinger Band mean on the weekly. It's supposed to do that after an outrageous move to the upside. Okay? So that's what I want to say about Walmart, and that's what I want to say about the squeeze play and the max Payne range compression. We okay on that, guys? Is that making sense to you? Say. So in a more general sense, then, this is how you can start chaining together some of these different concepts that make sense to you. All right, this idea of, I just want to revisit and summarize. The squeeze led us to a discussion of MPRC and end of day trading, and then the essence of that allowed us to take a look at these mechanical signals, and we can take some of the insights from this logic to start thinking about the 5D down, washouts, triple screens, 551W, overreaction and channeling. And now if you looked at something like the continuation pattern, right? So the continuation pattern is where we had something that started off as a mechanical signal or even a strategy. It could have been auto framer, sideways quiet channel, could be MPRC, it could be the squeeze. And we have a positive trade, meaning that it went in our direction and we cashed. And that so it went up and then it sold off, and so we did the 2-hour battle drill and we cashed in that win. And so this is where we got in, and this was our initial risk. So the continuation pattern is nothing more than saying whatever our initial risk was. This initial risk says that this upward move was not going to happen, and in fact, whatever caused it to come down to this level, there's more of that coming. So this initial risk on these mechanical signals turns out to be, in my view, a pretty important mark in the sand for the swing trade. So now a continuation pattern I want you to think of as this case, that whatever the mechanical system or the strategy happened to be, it gave us an entry, it gave us a move. The 2-hour battle drill caused us to cash a winner. And now, instead of this thing coming all the way back to violate this downside, that's where we're justified in going short there. But somewhere between where we got out and the original risk, it gives us an upward move. So we could say this was a low, and this is going to be a higher low, and so now we have like a P4 in the RLCO. We have a low and a higher low, and then guess what this looks like? This looks like a pocket. And then the previous swing high will generally be the emerging dragon. And so our universal entry or a continuation pattern allows us to get in somewhere between this low and the emerging dragon. So this is a pocket entry or a continuation play. That pattern right there you can think of as the P4 in the RLCO system. It simply had a low and a higher low and a resumption of the original powerful move. When it doesn't comply with any of the other RLCOs, that's what I just call a P4 or a continuation. You see that a lot with these kind of grinding moves that look like this. It's moving up, generally speaking. It has a series of higher lows, one after the other, and there's no simple way to get into that on any of these mechanical patterns, which all tend to feature a big move up, a sell-off, and then a resumption. But if that sell-off is never large enough, hey, all that means is that there's no selling pressure, that the buyers keep pounding on this thing every time it dips a little bit. That's very favorable. So this pocket reentry or a continuation pattern is a nice way to keep getting on board this long freight train to the upside. Okay, so that was question number one. Okay, question number two. This one's easier. Notice the color coding of the trend measurements in the market mosaic. Let me pull that one back up real quick and show you which ones he's talking about. Market mosaics. Yeah. So in the area that this question is concerned with is in these price respect to the 200-day moving average and the slope of the 50. These values here are coded green, white, yellow, and red. And these use a standard formula and a standard interpretation. And it looks like this right here. So anytime one of those is colored green, it's because its reading is more than one standard deviation greater than the average. And in general, my standard practice looks like this. I generally look back 180 days, and I find the max and the min and the average. And then I find the standard deviation of that. And then we put plus 1 and 1 minus 1 SD. So this will typically look like green, white, yellow, and red. Anything where you see me using the 4 color codes, that's how that's being computed. We find the average, the standard deviation, the max, and the min, and we get this this plot. It looks like this. And the way math works, this generally means about 1/6 of the values or of that look back period were in the green, about 1/6 were red, and about 1/3 each for white and yellow. So if the reading today was white, that means it's in the upper half, but not in the upper 1/6. Okay? Next question. If the auto framer targets have been entered pre-market and the market starts up, triggering the buy orders on some or all of the targets and then stops and reverses, how long do I stay in these swing positions if I'm actively monitoring the market? If not monitoring the market and the I-stops are still in place, there could be some large 1-hour losses on them. So my answer on that is, first of all, any 1-hour loss is as large as any other 1-hour loss when traded at the production level of risk. So by that I mean there is the execution risk and there's the position sizing risk. And whatever that execution risk is, I'd like that to be 1/3 of the position sizing risk. So what I'm using on the auto framer is really a position sizing risk. And so if it does sell off, so it went up and triggered us in and then sold off, and it came all the way down to that mechanical stop, that would be a -1R. That 1R stop is no bigger than any other. I mean, the dollar's loss is still the amount of money, the dollars at risk in that trade. So if my production size is 400, if this is a wide position stop, let's say that was $2, then I have 200 shares, because 400 divided by 2 is 200 shares. My execution stop would probably be somewhere around 0.70 cents. So if I'm actively managing that position in the market, then that would lead to about a -0.3R. On a turbo position, I might be able to use 70 cents as my position sizing risk with my execution stop at 25 cents. In which case I could have 600 shares, because 400 divided by 0.7 is about 600 shares. But in any case, 1R is still 1R, and the 400 is still the 400. Okay? Number 5. Can we base a mechanical system use on the MACD 10 and 30 crossover? This section here describes, Kim posted a really nice set of studies, which I commented on during the week, and he gained something like $4.40, $2.40, and his biggest losses were like -0.2 and -0.3. And all 4 of these days were positive expectancy. And so I'm going to say, yes, I discussed that in a daily debriefing using your chart, and your studies also demonstrate the power of that directional bias very well. I think Kim asked me this question. There was a follow-up, and it was pertaining to Glenn's swing trades that was something like ADR, and Glenn sent me that list of trades. I will publish them and do the trade index analysis this week, and we'll be okay there. Okay. Number 7, this was about the MPRC, and I think I've answered that one, and I tried to capture that in that text, but I think the verbal answer was definitive. Oh, I'm sorry, number 6, I missed it. On a swing setup, does it ever go stale? I generally think that like 5 trading days on those mechanical systems, if the 5DD hasn't worked in your favor in 5 days, then it's probably not going to work. And what it really is probably, it has probably become a sideways quiet channel. It might look like this. And if you had like a big day down on that 5th day, and so you frame the trade this way, and then the next couple, 3 or 4 or 5 days were all like inside this range, that could happen. And now what you have really is a sideways quiet channel. That's the important pattern. And it's no longer this big sell-off. So now we would take our rules like this. They break out in either direction. And then that's an SQC. You will see that is generally the case with all of the mechanical systems, that they work usually very quickly after the setup day. And if they don't, if they just muck along, generally what's happened is that the energy and emotion has left the building. And the next thing that occurs is it gets quiet, too quiet, and becomes sideways quiet channel. And so after 5 days, I no longer really care about the primary or the original signal. I'm really more concerned about the SQC. But I do like things that have, you had some Bollinger Bands and a big sell-off, and then it gets in here nice and tight. And then this gets to be pinched. And then the breakout pattern becomes the Z3 pinch breakout. Or even better, it becomes a super pinch when all of the regression lines all join, and now everything is tightly clustered together, and everybody thinks that's fair value, and then the breakout becomes even larger. So the short answer on that one is like 5 days, as a rule of thumb. Number 8, how do I check select the initial stop? Sometimes I'm using the swing low, another time a 2-day low, and then a third just the low of the last candle. A lot of that has to, I say, something that I could easily manage. And then your follow-up question, what does it mean to be easily manageable? I would say, look, on the swing trading, anything less than 1 ATR is kind of a really tight stop. Anything wider than 3 ATR is probably so wide that it's hard to see a 6R upside, and you may not be trading at a large enough size. So I think really somewhere between 1 and 3, and that's why I would almost advise pick maybe 2 ATR as a swing, as an initial one, for a position sizing stop. And then when you have that RL10, the price goes down and then the RL10 goes with it. If you kind of pick the RL10 as the execution bar, and if you're getting an entry here, you may see 1 ATR here and then 2 ATR here. Maybe use 2 ATR as a position sizing stop, and then maybe the swing low of the RL10 or the belly of the dragon if you're using the dragon as an execution. So now this is your execution risk in here, and this is your position sizing risk, and that should work pretty good for you. I would give that a try. Okay, last question. Could I expound on the additional Bollinger Bands added to the MACD study on Devon that was added to the daily report on 22 February, and more specifically, why the Bollinger Band 8 and 0.25 and Bollinger Band 8 and 0.05? Okay, so let me find that one real quick. I thought I had it available. Stand by. And the bottom line on that one is this was a, let's see, here's why I label my files the way I do. So we're going to try to find MACD histogram 208, 2018, 02, 22, Devon. So out of about 10,000 files in there, we quickly get to this one. So the question was really down here, these additional Bollinger Bands. So it's the Bollinger Band 8 and 2.5, and then 8, 2.5, and 8.05. And instead of using the 10 is really the essence, or the 30. These act like the dragon. Up on the price action, we use the river as 30, and then we use the dragon as the 10 period plus or minus 0.5, and then the baby dragon as 0.25, 4, and then 0.25. Well, on a weekly chart, those moves are waiting 10 weeks for it to turn might be a little slow. So this is Bob Rourke's chart, and what he's done is tuned that a little bit so that on weeklies, he's getting a front run on the 8 period rather than a 10 period. He's getting the turning point in the dragon 2 cycles faster than on the 10, and that's all that really means. And then using the 0.5 and the 0.25 simply gives a scaled dragon inside this Bollinger Band river. The other refinement he's put on here is that he uses the 30 period Bollinger Band plus or minus 1, plus or minus 2, and then plus or minus 2.25. And he uses that 2.25 because we have often talked about trading from Z2 to Z2. So he puts 2.25 out there as a tripwire that something has officially gone well beyond the Bollinger Band 2. So in a larger sense, the answer in this case is simply that he likes the extra front running information available from a slightly faster Bollinger Band, and then he uses the 0.25 beyond Z2 to make it a significant enough move past that it gets his attention. And I would just also observe that because it's on a weekly chart, which is what he likes to work on, he likes accelerating it to 8 weeks rather than 10 weeks so that he can get into those swing trades a little bit sooner after they've made a really exaggerated move on the weekly charts. It gets down to two Z's. He'd like to get into that a little bit sooner. So this is one of those where it's a good idea to learn the general idea of the indicator and what it's supposed to do. The fast Bollinger Band versus the slow Bollinger Band gives you ideas of significant turning points. And then you tune those to your own needs and your own ability to manage. So that's essentially what you can take from that study. Okay. What I'm going to do is take a break, and I'm going to do the portfolio update recording a little bit later. I'm going to hang that on the YouTube website. There's really not much difference going on in there because there was not much volatility. But I need to take a break right now and for a short while. So let me get this thing processing and hung, and then the other video I'll get hung up here in about an hour. And that's just going to be a rapid look through the portfolio. What I would encourage you to do is take a look at the weekend report link that I put in. I actually framed a half a dozen of the most interesting frames for you to study. It was looking at like Walmart and XLK and Brazil. And those are the ones that I would ask you to concentrate on. Okay, so pending any final questions, that's everything I wanted to cover tonight. and then I owe you a study of Glenn's work, and I'll get that posted shortly as well. Hopefully by not later than Tuesday. Okay, so last chance. Let's see. Let's see. Somebody asked me the question: does a continuation pattern have to make a new high? It doesn't. Although if it does, that's what I think of as the emerging dragon. So just real quickly. So we had some successful trade. We exited, and then there was some number of selling days. I'm just going to draw this as the last selling day. Imagine that's red. So that was a selling day. And then what I look for, and if this was the initial stop down here, so it's going to make a turn and go up without ever getting down this far. If it opens inside yesterday's candle and then makes a new high compared to the previous day, this is where I buy. So it didn't make a new high compared to the swing high, but it made a new high and a higher low in here. That's what makes it a universal entry. And then I can put my stop here, my execution risk stop right there, and then my entry is here, and maybe my position stop is down here with 2 times ATR. So I'm not going to take a full 1 hour loss on that one. So this is the characteristics of the universal entry, the UE. Okay, so that's the universal entry. All it did was made a new high compared to yesterday's high, which was the last day of selling. And then this is a white candle. It opened up inside yesterday's range, took out yesterday's high plus that little 5-cent buffer, and now we're in. And now this is the emerging dragon entry here. This is that swing high. If it takes that out, then this is really off to the races, because this is the price up here that negates this entire selling. Bob Gardner called that the candle negation. So whatever that long, strong move was that we got, and then we cashed the win, and then we got a universal reentry, that's a continuation pattern. This really now looks like a pocket inside here, so I would call that a pocket entry. Okay. Very good. Okay. That's everything, guys. Take good care. Let's go Red Wings. And congratulations to Russia and Pavel Datsyuk. That was as exciting a game as you could ever want to watch. The Russians were down by 1. They had led the whole game, and then Germany rose up and scored 2 to make it 3-2. And then with 2 minutes and 11 seconds left, the Germans got a power play, and you think the Russians are done. But they get possession of the puck with Datsyuk on the ice, and they pull their goalie, and they work it down low, and they work it into the crease, and they score to tie it up, and then they win it in overtime. And Pavel Datsyuk joins the list of 28 hockey players who's won a Stanley Cup, a World Championship, and now an Olympic gold medal at age 39, oldest man in the tournament, and a beautiful player and a wonderful person. So, awesome. Congratulations to the Olympic athletes from Russia. Somebody asked me, what kind of message is that sending that we ban the Russians but then allow the Russians to play? And it's actually a great message. What it says is we're going to cast shade on the Russian government for their international behavior, but we're not going to punish the individuals for the idiots that they have in government. And it means that every time a Russian athlete wins a gold medal, we're going to remember how crappy the Russian government has been, but we're going to celebrate individual people and respect their effort. And then everybody who wins a gold medal knows that it's not with an asterisk. They actually got to compete against the greatest athletes in the world, and now that gold medal is even more meaningful to people, for the people who did participate. So well done to the Olympic Committee for allowing the Russian athletes to participate under those conditions. And let's pray for peace going forward. So, you guys take good care, and we will see you in the chat room.